In this learning objective, we describe some of the most common classes of alternative investments, including tangible assets, commodities, private equity, and derivatives. So first of all, tangible assets, as opposed to financial assets, are those assets that can be touched and felt. So they are something that the investor can physically obtain in addition to their ownership documents. So what we know about most traditional assets is that they tend to simply just be financial contracts. So a bond or a share is a security that exists in the form of a contract, whereas a tangible asset might be something like the land, buildings, natural resources, or vehicles. That is something that the investor has as a physical ownership. Now, in this discussion of tangible assets, we're going to concentrate on real estate, which include lands, buildings, and related resources. But there are a number of other different types of tangible assets. For example, there's a big industry in investing in art. One of the key benefits of that is that art should have very low and possibly negative correlation with traditional asset classes. Equally, some superannuation funds have started to consider natural resources such as timber farms as part of their mix of asset allocation. But focusing on real estate investments can be actual, they can be tangible, or they can also be some sort of security or a derivative contract. So actual real estate may be either non-value added, such as land, can be value added in the form of land and buildings, or it can be value adding in the terms of things like timberland or mines. Whereas when we have intangible real estate investments, this is where securities are constructed, whereby the value of those securities are related to the value of the underlying real estate. So this includes buying mortgages or mortgage-backed securities, or real estate investment trusts, which are securities that trade on a stock exchange, and they're a fund where the underlying assets held are a bundle of real estate assets that are securitized and sold off as units. Now, there's a range of different ways that investors can go about investing in the real estate asset class. So free and clear holding is where they have an unencumbered full ownership right for an indefinite period of time. So that you can think of this as buying a block of land or buying a house and land type package. But that's by no means the only way within which people can go and invest. Many people, when they buy their house, will have a mortgage. A mortgage is where there's a loan secured by the underlying real estate made to third parties. So in this particular case, if your mortgage loan comes from the bank will have the title over the house until the house is repaid, such that if you default on that loan, there is the ability for the bank to go and sell the house and land in order to pay off the loan. So this relates to the idea of leveraged equity. So leveraged equity is where full ownership rights are encumbered by some form of debt or a mortgage. So the debt can be a promissory note unrelated to the real estate, or a mortgage, which is the loan that's used to purchase the real estate. I mentioned before that other forms of real estate investment include aggregated vehicles, and these can include things like real estate investment trusts or real estate limited partnerships, where you have a number of investors who pool capital together, and the pooled capital is used to invest across the real estate asset class. Now, in terms of some of the characteristics of real estate as a form of alternative asset class, we know it holds some of the properties that are consistent across all alternative assets. And the first and most noteworthy of those is that valuing real estate is very difficult. The reason is that because if we think about the value of any asset as the present value of future cash flows, it can be questionable as to what you use as expected future cash flows, and also the discount rate is also maybe potentially not that easy to identify. So when valuing real estate, one has to estimate the actual value of the land and the potential for value add, as well as ongoing costs associated with that real estate. And in terms of this valuation, there might be discounts that also get applied to the valuation, because we know that properties are immovable and usually indivisible, so we can't often break a real estate investment up into small parts, with some obvious exceptions. Properties are only approximately comparable in value, so if we wanted to use some relative valuation approach, we'd need to find two properties that are identical, and it's unlikely that two properties will be exactly the same. There's also no market that exists for buying or selling real estate. So this means that this asset class is highly illiquid, and also we don't have publicly available history of past prices across real estate that we can rely upon in terms of making valuations. And transaction costs and management fees are also very high. And this is a limit to arbitrage that prevents people from often exploiting inefficiencies in the real estate market. So given difficulties with the valuation of real estate, it might be useful just to have a look at what some potential approaches might be. Well, basically there's 4 approaches. First of all, the cost replacement approach. This is the question of how much would it cost today to replace the real asset. So in this particular case, one needs to estimate the value of the land plus estimating the cost of improvements, etc. Replacement cost approach is often used for the purposes of insurance. The problem is that this approach is limited in value, as we need to estimate both the value of the land and the market value of any building, which may differ enormously from its construction cost. So if you've got, for example, a very old house on a block of land, the price of rebuilding that land could be considerably more expensive than what that house is actually worth. Or we can also find the opposite, that we might have an office building that might be very valuable because it has some prestigious long-term tenants, and in that particular case the value of the building itself might be a whole lot more than the replacement cost. So as discussed before, this approach used for insurance purposes, but not tend to be one that's commonly applied as a way of valuing real estate for the purposes of investment. The sales comparison approach is a very common approach that's used in the valuation of residential properties. This is basically where you find a property that's got similar characteristics to the property that's being valued, and using a matched pair or comparing properties that have the same characteristics, you then say, well, if these 2 properties have the same characteristics, they should have an equivalent value. For commercial properties, often the income approach is used. So the income approach is basically taking the present value of future cash flows, whereby you might look at the net operating income that can be generated by the property investment. And we might think of that net operating income as either a perpetuity, like we have in the screen here, or we might assume some sort of constant growth rate through time, in which instance we would apply the same formula as we've seen before in terms of the dividend discount model. Now, in terms of coming up with a required rate of return or a discount rate with valuation, that's often the most challenging aspect of valuing real estate using this method. As a rule of thumb, often discount rates of 5% are applied for residential properties and 8% for commercial properties. But again, this is only a heuristic. Another way to consider the value of K would be to rearrange this equation and say, well, on aggregate, we can get an estimate of what K should be as the ratio of benchmark net operating asset from a property divided by the benchmark price of properties, and we can get a feel for what that return should be. The last approach is using the discounted after-tax cash flow method. So this is based on the fact that while an investment is worthwhile when its expected net present value is positive, alternatively the investment yield should exceed the investor's required rate of return. So what we're doing here is thinking about the future cash flows and bringing it back in terms of today's dollars to work out whether or not the property has a positive net present value. In a nutshell, it's applying exactly the same approach to valuation as what we see in traditional project evaluation problems. But again, there's issues with this approach. First of all, because the future cash flows can be difficult to estimate. In particular, we talk about future cash flows, we might talk about the terminal cash flow. Second, property theoretically as an asset class can have an infinite life, whereas we generally only calculate NPV for projects that have a finite period of investment. And also, as we discussed before, we need to come up with some method of being able to identify a discount rate to value the real estate. So that's real estate investment. We can see, while it does have some benefits as a tangible asset class, there are problems associated with valuation and also the low level of liquidity that this asset class brings. Some other options include commodities. So Commodities, we know, are natural resources. They can be agricultural, energy-based, or mineral-based. And the benefit of investing in commodities is they often have quite low correlation with traditional asset classes. So what we know about commodities is that the price of commodities tends to be most heavily influenced by inflation. So commodities have positive correlation with inflation through time. And given stocks often will be negatively correlated with inflation, this means that the commodities won't co-vary all that much with stock returns through time. So there can be huge diversification benefits for adding commodities to a portfolio comprising equities. Some issues, though, that we need to consider is that obviously the price of commodities are influenced by a number of factors. Weather, transportation costs, and supply and demand are key determinants, as well as external factors like the growth in population might affect the demand for commodities, and improvements in technology could also change our consumption of commodities and in effect have a negative effect on demand. So if we want to invest in commodities, for most people it doesn't make sense to physically hold the commodities. So it doesn't make sense to buy the raw commodities itself. Not many people would want to go and buy a whole lot of lead and have to incur the storage cost of storing it for a period of time. So there are other alternative ways that investors can access the commodities asset class without holding the physical asset. These include a range of futures contracts. So futures contracts are available, for example, on cocoa, coffee, corn, cotton, as well as all the more conventional commodities contracts like gold, silver, copper, and lead. And because the value of a future contract is related to the value of the underlying asset, this gives you exposure to changes in the value of commodities through time in your investment portfolio. Investing in commodities futures tends to be the most common way with which investors get exposure to the commodities alternative asset class without needing to actually buy the commodities themselves. Some other alternative ways is to invest in stocks that have a price that co-varies with the price of commodities. The best example of this is mining companies. We know that mining companies, their returns are going to be highly dependent on the price of commodities through time. Or alternatively, if you wanted to short particular commodities, what you might do is you might invest in a particular stock whose price is negatively related to the commodity price. So an example is, let's say you wanted to short oil prices. Well, one way you could do that is you could buy a stock in a transportation company, because transportation type stocks, their value is going to increase when the price of oil decreases, and their value is going to decrease when the price of oil goes up. So by investing in company stock whose prices are exposed to commodities, you can get exposure to this asset class. Finally, there's also a whole lot of listed funds that hold commodities as their underlying asset. There's some examples on the screen here of some of these funds that exist around the world, but commodity funds are another way for investors to get access to this asset class without having to hold the underlying asset itself. The final alternative asset class that we want to consider here is private equity. Private equity investing involves working outside the traditional feasible set of listed securities. It's where you buy stocks that are not listed on a market. There's several approaches to private equity, and often private equity will take place through the form of private equity funds. The first is a leveraged buyout. Leveraged buyout involves the purchase of all or most of a business unit such that a controlling interest is taken, and the capital in order to make that takeover is funded using a large amount of debt. So the companies that leverage buyouts tend to target are mature companies. The reason that they target mature companies is because mature companies generate strong operating cash flows, and those operating cash flows can be used to have some degree of certainty that the debt is going to be repaid that's used to fund the takeover. Another instance is growth capital. Growth capital is a private equity investment whereby the private equity fund will take minority equity investments in mature companies that maybe need capital to expand or grow. So you might have a private company, a non-listed company, that needs to access funds because they have a new investment opportunity available to them. So they might go to the private equity provider and ask for X million dollars in return for, say, a 10 or 15% stake in their business. Mezzanine capital, next of all, is an investment in an equity-like instrument, like either subordinated debt or preference stock of the company. So again, it's providing equity capital to facilitate growth